Hi everyone, welcome to class. Today we are going to be looking at ACC101 Financial Accounting. ACC101 Financial Accounting. Okay, today we are going to be looking at definition of accounting, definition of financial accounting. We're going to be looking at classification of accounting, accounts. Then we're going to be looking at how transactions occur. How transactions occur and how they are being treated. So these are the basic things we're going to be looking at today in today's class. We're going to be looking at the definition of financial accounting. We're going to be looking at the classification of accounts. Then we're going to be looking at how transactions occur and how they are being treated. We're going to be looking at the definition of financial accounting. Financial accounting can be defined as the process of collecting, recording, presenting, and interpreting financial entries or financial statements to the users of financial information. So you record, when you collect, you record, you present, and you analyze your financial transactions. That's what we mean by financial accounting, the process of collecting and recording and all that. Then classification of accounts. Now, accounts are classified into two. We have accounts. We have the personal accounts and we have the impersonal accounts. We have the personal accounts and we have the impersonal accounts. The personal accounts, from the word personal, are accounts of persons. Accounts owned or operated by persons. For instance, Mr. Chedi, AJ and Sons Limited, Mr. Ikechukwu, or Mr. Awodu, or corporations, individuals. That's what we mean by personal accounts. Then under impersonal, just the opposite of this, accounts not belonging to persons, and they are subdivided. We are going to look at their subdivision now. Under personal accounts, we have what we call the receivable account, receivable or debtors account. Then under we have the receivable. Then we also have the payable or creditors account. Then we also have the capital account and drawings account. Then we also have the bank accounts. Sorry, my board is small. The board is small. So once I'm done with this, I'm going to clean this up. So under personal account, we have the receivable or debtors account. We have the payable or creditors account. We have the capital account and the drawings account. Then we have the bank account. Then under impersonal accounts, let me use this direction. Under impersonal accounts, we have the real accounts and we have the nominal account. Real accounts has to do with real assets, what we can see and touch. Equipments, furniture and buildings, all these fall under real account. They are real assets, what we can see and touch. Machineries, furnitures, and all that. They come under real account. Then under nominal account, we have them in three categories. We have the income account, we have the expense account, then we have the intangible account. Sorry, I hope you can see this. Okay. So we have under nominal account, we have the income account, we have the expense account, and we have the intangible account. Income account, it has to do with inflow into the business. Expense, what we pay for, purchases and all that, money going out of the business, come under expense account. The intangible account, intangible are assets that you cannot see, you cannot touch, but they are assets belonging to the business. For instance, we have an example under intangible accounts or intangible assets. We have the copyright, we have the goodwill, we have the patent right, we have other intangible assets there. So these are the classification of accounts. We have them in two. Let me take it over again. We have the personal account, we have the impersonal. Under personal, we have the receivable or debtors account. These are people that buy from the business, customers of the business, people that buy from the business. While the payable or creditors account are those people we sell to, the business sell to. People that come to, people that supplies to the business. Sorry, that's what I mean. People that supplies to the business. That's people the business buys from. Do you get it? People the business buy from. They are the payable, or they come under the payable or creditors account. While these ones are people the business sell to. Do you get the difference? Then the capital account, then the bank account. Then we have under impersonal, is divided into two. We have the real account, the nominal account. Then under the real account, I gave you examples of items under the real account. I gave you furniture and fittings. I gave you plants and machineries. Then I gave you a motor van and all that. So these are assets, what we can see and touch belonging to the business. Then the nominal accounts, under the nominal accounts, they are divided into three. We have the income, the expense, and the intangible. Under the intangible, I give you examples like copyright, goodwill, and maybe the patent right. All right, that's that. So finally, sorry, I'll have to wipe this off. Finally, I said we were going to be looking at how transactions occur. How transactions occur. How transactions occur and how we treat them. Now, this is how transactions occur. We have the collection stage. Number one, we have the collection stage. Then number two, we have the recording stage. Now, for any of these stages to happen, there are books or entries. There are books in place where these recordings or these collections must be entered. Now, we have one of them is the source document. The second one is the subsidiary books. Then the last one, subsidiary or prime books. We call them either subsidiary or prime books. Then the last one is the ledger. So the source document, the subsidiary books, and the ledger. Now, the source document is the initial, this source document accommodates the initial recording of any transaction. At the first stage of every transaction, it's been entered in the source document. And what are the examples of this source document? We have the invoices, we have the receipts, we have the bank tellers, we have the vouchers, we have the bills and all that. They are under source document. So at that point, when the transaction happens, they are being entered in the source document. That is the collection stage. So the collection stage, every recording from the collection stage is being entered in the source document. Then from the source document, that is where from the source document now, they are now taken to their various books. Do you get it? They're now taken to their various books. Now I'm going to give you examples of, I've given you examples of this source document already. I gave you the vouchers, the bills, receipts, debit notes, credit notes. They are all examples of source documents. Accounting principles have not taken place here in the source document. It's just the initial stage where you record information in their raw stage. You just record the information, awaiting them to be recorded in their respective books. Do you understand that? So now, the subsidiary books, there are 6 in numbers. The subsidiary books now, there are 6 of them. Number one is the sales day book. Number 2 is the purchase day book. Number 3 is the returns inwards book. Returns inward book, or sales return inwards book. Number 4 is the returns outward book, or you call it purchase returns outward, or purchase returns rather. Number 5 is the cash book. Number 6 is the general journal. So these are the subsidiary books: sales day book, the purchase day book, the returns inward book, the returns outward book, the cash book, and the general journal. So from the source documents now, the entries there are now taken to their various source documents. The sales day book is used for recording goods sold on credit. Goods sold on credit. That's where you record. That's goods sold on credit. That you record them in the sales day book. In the purchase day book, you record goods bought on credit. When you buy goods from outside, from your suppliers on credit, you didn't pay for them, you record them in the purchase day book. In the returns inward book are sales returns, goods that you sold and maybe some of them were returned to you, maybe due to bad state and all the rest of that. You record them in the returns inward. Returns outward, goods that you bought from outside your suppliers and you discovered that some of them are bad or thereabout. Those returns are being recorded in the returns outward book. Then the cash book are for cash transactions. Yeah, the cash book is used for recording cash transactions. Then the general journal, it's where you record every transaction separately before they are being taken to the ledger. So these are the 6 subsidiary books we have. Then finally, the ledger. We have 3 of them. We have the sales ledger, we have the purchase ledger, and we have the general ledger. The sales ledger is also known as the debtors ledger, where you have details of all your debtors, all your customers, people that buy from you, corporations, individuals, all transactions relating to that set of people come under the sales ledger. While the purchase ledger are transactions or transactions with people that you buy from, your suppliers, be it company, be it individuals, they come under the purchase ledger. While the general ledger is every other transaction aside these two. Do you get that? Every other transaction aside the purchase or the sales ledger come under the general ledger. So that's that. So in a nutshell, this is how transactions occur. In a nutshell, we have the source document, we have the subsidiary books, then we have the ledger. So this is the process. The transactions, first of all, come to the source document, then they are being taken to their respective subsidiary books, then finally the ledger. The ledger is the final destination for every account. That's the final destination. From the beginning, from the source documents to the subsidiary book, from the subsidiary books, they are being taken to their respective ledgers. So that's that. So I don't know if there's any question. If there's any question, head right away to the comment section, ask your questions, and you'll get responses. And one other thing, these transactions that occur in our subsequent class, I'm going to show you how to know which to debit and which to credit. In our subsequent class, we're going to know about that. We're going to go into details on how to know which of them to credit or which of them to debit. All right, so we're going to stop here for this class. I don't want to make it too long. If there's any question, head to the comment section, ask your question. Please and please, if you have not subscribed to this channel, go there right now and subscribe. Hit the notification bell so you're going to be notified when we post new videos. And please invite your friends, share this video so that others can get value just like you are getting value. Thank you very much for staying to the end of the class. Bye-bye for now.